as the U.S. Consumer Price Index shaped views on whether the Fed could cut interest rates. Our chief equity strategist and economist, John Blank, here now to discuss that and more. John, you had written earlier this month that the June CPI might have a hand in shaping that view, but then we also saw the July CPI. Has that data combined had the expected impact on a Fed rate cut?
Well, Terry, let's put out the BLS Consumer Price Index summary that was issued on July the 11th, which was 2 weeks ago. So what we have here is it declined minus 0.1% on a seasonally adjusted basis after being unchanged in May. So we went from 0 to minus 0.1, so the direction was great. All items, the broad was at 3%. All items less get food and energy was a different number, and it was at 3.3%. So 3.0% for the broad for the 12 months ending in June, and a smaller but better 3.3% for the 12 months ending in May on the core. So all things considered, we're heading in the right direction. And the minus print, Terry, was really disinflationary, what's called disinflationary. So it was the first monthly print of a true disinflation moment for the U.S. economy, which is what the Fed wants to see.
Today, July the 25th, we saw the advanced reading of the second quarter economic growth. Was that encouraging news?
Yeah, absolutely. I mean, when you get a 2.8% number for the United States, that is above trend growth because we typically are 2 to 2.1%. So a 2.8% number is super strong. And where it comes from, and I'm reading the statements directly off the BEA's website, is it primarily reflected increases in consumer spending, private inventory investment, and non-residential fixed investment. So non-residential fixed investment, that's a construction infrastructure chips boom. The consumer is strong, and we're seeing people put inventories back up again after the supply shock, which means they're having more confidence in the supply chain. So all things considered, Terry, this is a very strong above trend report for a very strong economy.
I have to keep coming back to the $64,000 question, and it involves a September Fed rate cut. Tomorrow, the markets are going to see the June reading of the personal consumption expenditures. That's the Fed's preferred inflation gauge. So will the June CPI data showing a slowdown of inflation plus this week's economic data all be enough to put that likelihood of a Fed rate cut in September to 100%?
Well, the answer is clear, Terry. I'm on the CME Fed Watch right now, and it's July the 25th, and we have an 86% chance for a Fed rate cut in September and a 13% chance of 50 basis points. So basically, market is you're betting on 85% of 25 or 14% on 50 at this point in time. So really, Terry, the whole issue now is whether it's 25 or 50, not whether they cut at all.
Okay. What's the current bull-bear story then on the U.S. economic situation?
Well, whether things are all priced in, Terry. I mean, you had a 21 forward PE in the S&P 500, which is rich. Historically, it's around 17.5 or 18. So we can have a pullback because all the good news is in on the Fed rate cuts. And also we can have people oversubscribing to, 7 rate cuts next year when there might be 3 or 4. And that can also, change expectations. So as you and I know, it's not what is going on, it's what's priced in.
You've been seeing the continued U.S. Treasury inverted yield curve as worrisome for a while now, but also now you throw in the average interest rate on new credit card offers as worrisome. Why is that?
Well, because there's been a lot of loan sharking on credit card, lending by the banks, the major banks, and people who have actually been rolling over credit on their credit cards are getting stung with huge interest rates. I think that game has been played out and people are getting out of it. But if you can't, and a lot of the lower income groups can't, it's been a big problem and a lot of distress out there.
So what does the global economic picture look like now?
Actually, much better. 3.2 to 3.5% on the global growth rate from the, IMF when I looked into the latest update, and that was just a week or so ago. Pretty not going up or down, but certainly stable and looking forward to not a recessionary environment in 25.
You've recently written about using old political terms in a new economic time, and this can be a little bit of a complicated topic, but basically, what's up with that?
Yeah, Terry. So we are in the midst of a political election cycle driven by social media, which wasn't around 10 or 12 years ago and has, it allows, millions of people to choose political terms. So, one way to label your opponent is either fascist or totalitarian or authoritarian or, communist or, we are more for democracy and all these words. And so I wrote that piece because these are old terms that have been around and were built, basically around World War II and afterwards for that type of world. And it's being confused in a social media environment by two different crowds of people who are running for, or supporting their party for an election. So what I would just like to point out, when I wrote it, and I hope people do get the piece off of Zach's for my economic report about trying to understand what these terms actually mean and what actually would be accurate in using them today. That's what I wanted to point out.
And basically, that's the remedy?
Well, the remedy is, political science has got really good insights into, kind of buckets that people fall into when governments arrive, try to govern. And it really will help people understand, for example, whether you like me saying this or not, Donald Trump is a right-wing populist politician. And that's the accurate terminology for what he's doing. And then you're going to have to look to my report to understand both two terms I use, one right-wing and the other populist, because those are terms that political science is used to explain the types of approach that he's taking to policy right now.
So basically, the remedy is just have a full understanding of the terms you're using.
Correct. Yeah, that's the problem here. I mean, you can get very lit up, just like you might have gotten lit up when I just stated those terms for your politician or if you oppose him. And that's what I want to get people away from. I want people to understand terms and when they're applied appropriately, and then understand where things can go from here when you use them correctly.
All right, more strong buy stocks to watch include Vertex Pharma, EssilorLuxottica, hope I pronounced that right, and Walmart of Mexico.
Yeah, Vertex Pharma is up in Boston, Terry. I've got them at almost $18 a share in earnings. So this is, if you see a stock priced at $490, you might think, gee, why would I buy it? You got a ton of earnings. This is basically the major roll-up in Boston for the biotech cluster there. And I can go on for 5 minutes on all the names of these groups of things that they have been invested in. They call it small molecule drugs targeting serious diseases. So basically using, the really, really high-tech biotech environment around MIT to get drugs built, and they got the money and the pipeline to show for themselves. So gotta love a stock like this. We do have a B for growth on this.
And EssilorLuxottica.
Yeah, so you might not know this one because it's a European name, but you do know the products: Ray-Bans, Oakleys, Sunglass Hut, LensCrafters. So this is based in Paris, France, and it's basically an optical company. And so it's why it gets put in the medical products area. But Bart, it is also, in some respects, a consumer discretionary company. But the main thing to understand of it from this discussion is it's number 2 ranked stock buy right now.
Walmart of Mexico.
Walmart of Mexico, just amazing long and short-term statistics from us. Number 2 ranked buy stock, a B for value, an A for growth, and a B for momentum. Rare to see a stock get that solid a score. And you got a nice entry point here at $35 on a very safe stock that has a target price of $39, and I can see it getting to $42 on its 26 earnings. So if you're looking for a safe play to park some money and you like the story of Mexico right now, go ahead and take a look at ticker WMMVY.
Our chief equity strategist and economist, John Blank, on the U.S. and global economies. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.